All right, and it looks like we are live. So welcome everyone. It's recording as of right now. As participants continue to flow in, we're just going to have a little bit of banter, Josh, Ryan, and myself, as everyone's finding the time to log in. But for those who are currently able to see the webinar in front of them, it should say private credit, an important piece to the allocation puzzle. Again, we're very excited about this here at Beacon Pointe. We think it's going to be very informational. And Josh and Ryan have been very good friends of the firm for dealing with a lot of our clients, but also working through our due diligence process. Again, we're very, very confident not only in what they'll be able to talk about today, but going forward, if this is something that you'd like to pursue for either the portfolio that you oversee or the endowment that you work with. So again, very, very excited here. What we're going to do is it's about 10:01. We're going to give it about another minute. Make sure that those who are trying to log on, we understand either the problems from Zoom or the different issues that personally I had issues logging in as well this morning. So I get it. It's the world that we live in now, but we have the flexibility to do so. So what we're going to do is we're going to give it one more minute. Josh and Ryan, everything good to go on your end?
Perfect, Mitch. Thank you.
Good. I can hear you. That's important. Awesome. We can hear you. And what I've got now is my watch hit 10:02. So what we're going to do is we're going to start this, and I'm sure participants are going to continue to flow in. But what I wanted to do quickly is, again, welcome everyone to the Beacon Pointe Institutional Insights webinar. Again, the purpose of this is it's simply to help not only our clients, but those who are in institutional portfolio money management, whether that's sitting on boards or working with investment committees and endowments, foundations, nonprofits, really any type of institution that's got assets that need help. We want to help make the best decisions possible in the current macro environment. Now, if you've been following Beacon Pointe since about, March of last year, the COVID pandemic happened. And when that happened, we saw the Fed issue a lot of stimulus. Now, if you've listened to our Chief Investment Officer, Michael Dowd, talk about what financial repression is, great. But if you have not yet, I'll quickly remind everyone that is on this call, financial repression is the suppression of interest rates with the idea that inflation is going to run a little bit hot. What needs to be addressed now is the fixed income in portfolios, because when you have rate suppression and inflation running hot, your fixed income or your bond portfolio doesn't necessarily do as well as you would like it to do. So what we did, our due diligence team here at Beacon Pointe did, is we went out to try to address the fixed income or the bond portion of your portfolios and understand what managers are doing really, really well. So Derek Newcomer and our alternative investment team has gone out. They have found some private credit managers. And private credit managers, we're going to let Josh and Ryan explain what private credit is. But it's one of Beacon Pointe's answers to accessing more yield in a financial repression market. So thank you, Ryan, for flipping to this. Josh, what I'm going to do is I'm going to give a quick introduction of who you are, and I'm going to read word for word your bio, because I know I will botch it if I try to do it off the cuff. So Josh is here with us today. He's the founding partner of Stellus Capital Management. He's also the co-head of the private credit strategy. He's got over 20 years of investing, finance, and restructuring experience. Prior to joining and starting Stellus, Josh was the director in the Direct Capital Group at D.E. Shaw Group, which is a global investment and tech development firm. Prior to joining D.E. Shaw, Josh served as the managing director at Milestone Merchant Partners, a boutique merchant bank, and he was also the vice president of Duke Capital Partners, which was also a merchant bank. It was a subsidiary of Duke Energy. So with that, Josh, I'll just quickly say too, you received your bachelor's in accounting and finance from Texas A&M, which is always a very controversial topic in the Hughes household because, we like Baylor. So I apologize in advance for having you on the call, but that's okay. We're going to be able to deal with it anyway. So Josh, want to make sure that you're able to take it away here, but thank you very much for being with us here and being really a part of this webinar series.
Awesome, Mitch. Thanks for the introduction, and I will give the Baylor Bears full credit for a great basketball season and national championship. My Aggies have a long way to go to catch up to that. So, but appreciate the introduction. Stellus was formed in 2012 through the spin out of our group from the D.E. Shaw group. D.E. Shaw, a very large New York-based hedge fund. Our business is really focused on providing debt financing to private equity-backed businesses in the lower middle market of the U.S. We're managing about $1.8 billion in assets right now, and that's across a number of vehicles, several private equity-style funds, several SMAs, so separately managed accounts, as well as a public business development company. The firm's headquartered in Houston, and we have a couple offices in Washington, D.C., and one in Charlotte, North Carolina.
Perfect. And before you get into the bulk of this presentation, I need to quickly note, if there are questions that come up during this call, please feel free to email them to myself. We want to be able to address any question, either particularly in this webinar, or also I'll work with Josh and Ryan to make sure that we are able to address all questions that you may have. So again, my email is M as in Monkey Hughes. You can see there in my title, HUGHES @beaconpointe.com. Sorry, Josh, I just wanted to make sure that questions were able to be had, and Robin was able to drop that in the chat.
Perfect, thanks, Mitch. So slide 3, for those of you who are familiar with it, you'll understand, and this might be a little bit of repetition, but what really is private credit and what is direct lending? I think the simplest way to talk about direct lending is all of us know about bank loans, and direct lending is really just a private bank loan outside of the banking system. So this is not a publicly traded instrument. It's not a loan done by a bank, but it has similar characteristics. So we have a stated coupon, typically floating rate. Sometimes it's fixed, but most typically floating rate. We have an amortization schedule and a repayment schedule, and then we have a term, a final maturity on the loan. And just as importantly, we would have robust reporting and covenant packages that allow us to monitor the loans. It's a great alternative to other fixed income products. And the difference really is it's probably a better risk return, but in order to get that better risk return, you're going to suffer the illiquidity. So, you're not going to be able to trade. Really, it's for most of our LPs in our private funds, this is really viewed as an alternative in the asset class, whether that's part of their sleeve from venture capital, private equity, hedge funds, et cetera. And now, just given this low interest rate environment, we've seen a number of our institutional LPs really view this coming out of their fixed income allocation and being willing to lock up assets and suffer the illiquidity for the significantly higher yields they're able to achieve in a direct lending portfolio. You can see graphically on this slide, the comparison with public and private. And really, again, think of this as its senior first lien debts. It could be second lien, it could be subordinated or mezzanine when people talk direct lending, or it also could be a product that's really probably the most popular today with funds and businesses like myself, which is a unitranche. And a unitranche really is just a single lien that covers everything from the top of the balance sheet, that first lien loan, and encompasses all the way through to the leverage of a second lien loan, but it's structured all as a single loan and a single lien. It's really popular. It's popular across really for its simplicity for the borrowers, and it's extremely popular for folks like myself because we like to have the control over the loan and the assets ourselves when there are issues that inevitably can come up. So maybe slip to slide 4. Again, on slide 4, this is a much broader snapshot of the private credit universe. You really have at the top the direct lending that I'm talking about today, specifically things like first lien loans, the unitranche, the second liens, and you can see the associated yields with them flowing through into kind of opportunistic strategies. So this would be some of the tradable hedge fund strategies and credit you might see, all the way down to very esoteric lending strategies. That could be aircraft leasing, that could be drug royalties, it could be litigation finance. And then lastly, an asset class many people are familiar with in private credit, distressed loans and distressed lending. And as you see, throughout the spectrum, you're going to get higher returns in what I would deem as probably the higher risk assets. So the distress is going to look more like a private equity vehicle and have the type of variability you would see in the returns. Whereas you look back to the top, the direct lending is probably going to be and should be the most stable vehicle you have. And we like to think that the best risk return and probably the best alternative for a fixed income product.
And Josh, I do want to ask too, we get a lot of questions from clients around how do you determine the mark to market, right? These are private deals. They're not something you mentioned in the slide prior that it's not on the public market. So I'm guessing rating agencies aren't involved. You're not seeing S&P or Moody's come knocking on your door saying these are AAA bonds. Is there an equivalent? And how do you determine mark to market?
Yeah, that's a great question, Mitch. So we do mark these loans to market. We're frankly required to for fair value accounting under GAAP standards. And what we do, and when we put a loan and we originate a loan in our fund or in our BDC, we actually get a shadow rating from an organization like a Moody's and a Fitch. Typically, these types of loans are typically rated, think single B. And then we actually tie that loan to the associated credit spread, to that shadow rating. The loans don't and aren't valued above par because we don't trade these loans, but they could tick down. And we do our valuations every quarter where we look at these credit spreads and how the loans moved. In a huge blowout situation where credit spreads go really wide, maybe immediately post-COVID, you could see low loans and even private loans in our book. We would need to value them down slightly, irregardless of what's happening with the underlying company. And what we found, interestingly, during COVID is, we probably saw our loans get marked down through our valuation process, which is, again, very systematic and quantitative, get marked down anywhere from probably 5 to 8%. And then as spreads narrowed through the course of 2020, as it became clear that there weren't credit issues, or at least significant credit issues during COVID, by the end of the year, those spreads had come back and our loans were, back from a mark-to-market standpoint, back at 100 cents on the dollar. But I think the important thing is we don't trade these loans. We're not a buy and sell. We are a originate and hold lender. And so those mark-to-markets are really for accounting purposes, but probably less important to our underlying investor, because ultimately we're holding these loans to maturity at 100% par, and oftentimes paid off at a premium because we get a prepayment penalty. So maybe on slide 5 for those controlling the slide deck, just again, real quickly, and I think this is helpful. This is really a good snapshot of different categories within direct lending that you might see. I operate in the lower middle market, predominantly in the first lien. There's a middle market segment that's typically larger businesses and larger loans. There's an upper middle market, and then ultimately there's bank type products like a stretched senior and a unitranche loan. And it's really a investor selection on where they want to play and what part of the risk spectrum are they comfortable with. And it's probably also a risk return. We like to think of the lower middle market. Frankly, we get higher yields and ultimately we're taking less risk. And we've seen that throughout our track record over the last 20 years. Some of the things you see over traditional lending that we think, again, are real advantages for private credit is just flexibility of terms. Like, why do people choose us? We can be more flexible. We're not a bank. We're not encumbered by regulators. And so we can be much more flexible in how we schedule cash flow payments, how we schedule amortization, how we manage the loan. Our ability to quickly tell borrowers whether this is a fit or not is incredibly helpful. We don't have some big giant bank to go through, and we style ourselves as investors, not banks and not lenders. We really view ourselves as an investor. And lastly, again, most of our loans in this space, and I'd say probably the vast majority, are really owned by private equity firms. We like having that cushion. We like having the alignments of interest, and ultimately we like having another party that can support the business with cash equity when times get tough. Page 6, this is a huge segment. When I think people get lost when they think of the middle market and what it is. But quite frankly and simply, it's really the largest swath of the U.S. economy. 180,000 different types of companies, across the industry, and in our case, we're really industry agnostic, so we really see all types of these businesses. Whether they are a $8 million EBITDA business or a $50 million business, we're going to look at it, we're going to evaluate it. And it's really, interestingly enough, a space that most of the large banks have abandoned. And you really don't see any public market opportunities that arise here. And that's why you see better pricing at the end of the day through this middle market and lower middle market, because there's not, again, public market alternatives, and many of the banks can't do their syndicated loans there, so they just don't do it. And again, we think this is going to be the segment of the U.S. economy that will continue to grow, that will continue to be successful, whether that's entrepreneurs or family-held businesses, ultimately selling to private equity firms and then growing and making acquisitions. Continues to be just a tremendous and really, really large segment of the economy to take advantage of, and frankly, access through direct lending. So, again, continuation on the market opportunity, and this is really, interesting slide. This is what, if you look on the far left, kind of pre-financial crisis in 2008. There was a lot of different participants, from banks to CLOs, insurance companies, hedge funds were really big into this, and then regional banks. And what we saw out of the crisis was really an elimination of a number of these competitors. The regulatory changes, both at the bank level and some of the kind of reassessment on liquidity by the hedge funds, really drove this business coming out of 2009 into a much smaller universe of players. You have your public business development companies that, while they really can only raise money when their stocks are trading at a great level, and it's really opened up the opportunity post-financial crisis, so 2009 to today, to private funds. And those private funds could be structured as closed-end, they could be private BDCs, and ultimately, we've seen a decline in the market share from what I would call the banks, and most importantly, regional banks. I'm not, I could make lots of comments, but I think at the end of the day, many of us who look to get loans or want to get loans, we find that banks actually don't want to lend money. They really just want to earn fees and hold your assets. And so it's really given rise to a huge opportunity within direct lending for non-banks. And I think that market share, will continue to trend down for the banks, and you'll continue to see more and more capital raised in this private nature for businesses like ourselves. So snapshot, real quickly on funding, and you can see, with the exception of 2020, this has been really a continued step function up in both private equity and private debt fundraising. I think COVID put a chill on all fundraising, but it's snapping back very, very rapidly for 2021, and I suspect 2021 will look a lot like 2019, and probably even higher. Again, private equity, most of the loans that we would do will be backed by this private equity, so it's an important characteristic for us. The more dry powder that sits in these private equity funds, the more deals are getting done, the higher our deal flow is, and quite frankly, the more stable our sector is, both from a return standpoint and an origination standpoint. So again, maybe some distinguishing factors. Did I jump ahead one? Yeah, go back to 9. There we go. So again, distinguishing factors. I think it's helpful. These are, at the end of the day, think first lien senior secured loans. There are some second liens and some mezzanine loans, but that's really investor selection. Our vehicles are predominantly first lien loans with a small amount of equity invested alongside it, and the occasional second lien loan. We really steer clear of subordinated and mezzanine debt. Again, you have the ability to select whether you want lower middle market, you want middle market larger, or you want much even larger corporate. You can make the decision: do you want private equity backed? Do you want family held? Do you want larger and public? And at the end of the day, what area and what cycle do you want to be in? Anywhere from venture loans to distressed or to more growth oriented businesses like ourselves. And again, other characteristics. Oftentimes, we're probably the sole lender in our businesses, but you can make and look at opportunities that might be club, meaning 2 to 5, or a much more broadly syndicated, 50 to 80 to 100, lenders. And I think these are all various considerations you would make when looking at different fund managers. Obviously, probably the most important is going to be track record and the longevity of that track record. How experienced are the fund managers and managing across a cycle? How well did they do in that 2008, 2009, timeframe? How well have they done, during a tough period during COVID? I think those are probably the most important considerations when thinking about, fund selection from a manager standpoint. And then even specifically, how do they source opportunities? How diversified is the portfolio? What is the actual loss rate over time? Things like this are, I think, ultimately what are going to drive most investors to invest with one firm over another or one strategy over another.
And Josh, thank you for that. And you've done a wonderful job of explaining, look, there's an opportunity here. The banks aren't lending to the middle market segments like they used to pre-2008. And so we want to incorporate this into our strategy. And so we have clients that are asking, okay, we like the idea, but how do you do it? And so there's a few different ways that you can. I'd love if you can elaborate on two questions. The first one being, is there more of a mutual fund structure, which, is the evergreen interval fund structure? And can you elaborate on that versus what yours is, the LP structure? You do the direct deal. So if you can distinguish between both of those, that'd be incredibly helpful. And then you also touched on it a little bit, but the important thing that we focus on at Beacon Point and why we like Stellus is the deal sourcing capabilities. And if that's something you can elaborate on a little bit more as well, is if you're selecting one of these managers, can you talk about what it means to be a good sourcer of deals? How do you find those, and what's important to your team in looking at them?
Yeah, sure, Mitch. So I think first, in terms of different vehicles, they're the closed-end options. There's obviously public BDCs if you want to wade into the public market, and then ultimately there are those interval funds and private BDCs. And I think they, I wouldn't say any are better or worse than the other, and so it's really an investor preference. I think oftentimes offshore investors prefer a private BDC or an interval fund because it naturally will cleanse the investment for ECI or UBTI, if that's a consideration from a tax standpoint. Many of our LPs, it's not a consideration, so it's probably easier to not to go through those structures. But I think they're all interesting. Currently we have a private fund structure, but we will likely add at some point a private BDC because again, it's all about investor preference, and for some investors, it's not just about being ease. It's probably a preferred structure from a tax standpoint. The evergreen structure is great. We have and we're entering into one now with an investor. Quite frankly, it's a larger pension system, and they don't want to repeatedly go back every 3 years to re-up. They'd rather have a defined investment period and then continue to invest with us as long as the performance is strong and not to have to go that way. So I would say I think they're all great, interesting structures, and it's all about investor preference, tax structuring that probably drives the one over the other. As it relates to deal sourcing. There's three really, really important aspects in this business. It's sourcing, it's the execution, origination, diligence of the loans themselves, and then it's portfolio management. You can't be good at one and not good at the other two. You have to have all three. Deal sourcing for us, I would say pre-COVID, it started with us being out on the road all the time. So getting on the planes and visiting all of those companies, those referral sources, being in front of our private equity clients, being in front of lawyers, accountants, being in front of commercial banks who can't lend to their clients anymore, and then getting those introductions to those family-held businesses, to that entrepreneur, and working with the private equity firm. So this is for us, I really view, if you talk to one of our managing directors on the ground on a deal team, 30% of our time needs to be spent on origination. 30% of our time is probably on diligence and structuring and executing an agreement, and 30% of the time has got to be on managing the portfolio. We will look at literally, in the course of a fund, we will look at several thousand deals to get down to the 40 to 50 deals we ultimately fund in any one vehicle. And we take the philosophy that the more deals we see through our origination, the better credit decisions we're going to make. And as a result, the better returns we're going to generate for our investors. So again, maybe graphically, just a quick snapshot. We really run and lend in this first lien and unitranche bucket. So think our typical loans will be anywhere from LIBOR 550 up to probably LIBOR 800 or 900. We will occasionally do a second lien loan that might look like a LIBOR 900 to a LIBOR 1000. LIBOR is changing. We will probably move to SOFR, but that's yet to be determined. You will not see us do subordinated debt or mezzanine. We think that is a tougher asset class from a risk return standpoint these days. And we oftentimes will, as part of our loans, we will take a small piece of equity. So oftentimes we are investing, somewhere between, in the context of a portfolio, you'll see it as 95% debt, and about 5% of our portfolios, 3 to 5% will be in equity. And we like those little equity kickers. We think they really enhance the overall yield of our portfolio. We found them to be very, very valuable over the course of the last 20 years from a return standpoint as well. This slide gets back to a little bit of what I talked about, kind of segueing out of origination. To me, this is all about underwriting, so that diligence and the ultimate execution. We've looked back at our default rates, our recovery rates, and our yield, and what we found over time is that when we compare our default rates to publicly comparable securities, our default rates, and here we're talking about payment defaults, so the worst type of defaults you can have, not a covenant default, but an actual payment default. Our payment defaults are really low compared to publicly rated securities. And when we do have a payment default, our recovery rates are substantially higher. And at the same time, our yields in our loans are substantially higher as well. This tells us and tells me we've got a much better risk return model. We're doing a really good job underwriting, and we're outperforming anything you could find from a risk return standpoint in the public markets from a fixed income standpoint. And again, this to me, again, another slide talking really about risk management. And for us, that's portfolio management, and that's the underwriting and execution. So we need really strong covenant packages. We want to know well in advance if there's a problem. We want to be picking it up in our documents. And that's just not things you see in public fixed income products. So we're testing covenants monthly or quarterly. We're testing total leverage. We're testing fixed charge coverage. We're testing EBITDA. We want to have mechanisms in place that allow us to know if there's a problem. And quite frankly, our company should be communicating this to us well in advance. We oftentimes have board observation rights with these loans. So we are touching the borrower, typically once a week, having calls with them several times a month, and then ultimately sitting in the board meetings, understanding what's going on. We tend to have pretty focused expertise in certain industries that we've developed over time that allow us to get smart and knowledgeable about sectors. And then ultimately, with a private equity backed business, we're really going to be in partnership with that owner. If there's a problem, we want to know about it early, and we want to work with them not in an adversarial way, but in a partnerial way to figure out how to solve it so that we get a good outcome for ourselves and that they still get a good outcome as well. we deal in the lower middle market. We really think at the end of the day that while direct lending is a great asset class, the real risk return arbitrage is in the lower market. We find that at the end of the day, leverage is lower, that pricing is higher, and that ultimately we have much more structure. And that's what I've talked about in the earlier slide, which is covenants and controls around the loans. We typically have only a few. We're either the sole lender or one of one or two that's sharing a loan. We don't compete with high yield bonds or syndicated bank loans. So we're able to get that structure. We're able to get that better pricing, and we're able to get the lower leverage. And when there are problems that have arisen over time, we're really able to, because of the nature of our loan and us either controlling the loan entirely or controlling it with one other partner, really control the outcome, keep that business out of bankruptcy, and get it moved, get it restructured, and get it to a point where it can ultimately pay us back. And again, I think that's why you see, if you go through our track record, you would see really low default rates, but even more importantly, you'd see really high recovery rates when there are problems. We like investing with private equity sponsors, as I mentioned earlier. We like having a cash cushion behind us. And importantly, not only do we like their expertise and the time they spend with their businesses, we really like their cash when there's a problem to come in, whether that's post-COVID, where there's a liquidity crisis, or whether it's they've lost a customer and they're going to underperform. We like the ability for money to come in to pay down our loan or to provide liquidity that we just don't see in the non-sponsored world. So maybe the last slide that I'll end with, and I think we're probably doing decent on time, but listen, we think in this market, we think you're getting paid for less liquidity. You don't have the liquidity, but what did you get? You're getting, we think at the end of the day, a better risk return. We think pricing is better, leverage is lower. You're getting the advantage of really directly originating loans. You're not a price taker. You're going to get deep underwriting and expertise, and which ultimately leads to better outcome. The tightness of our documents, the tightness of the covenants, all lead to, at the end of the day, just a better risk return. You get a very diversified portfolio. Typically, our fund businesses have anywhere from 40 to 50 loans, individual companies in the fund. So significant diversity, which we think leads to better outcomes. So if there is a problem, it's a small problem given the diversity. And we think this is a great asset class in volatile markets. I saw it in 08, 09. Our portfolio performed very well, and it was a phenomenal asset class then. It's been a great place to be during COVID. The portfolios performed incredibly well. There's a floating rate. Almost 95% of our loans are floating rate. So it's a natural inflation hedge. And again, the active management, much like you would see in private equity, really at the end of the day, yields lower defaults and higher recovery rates.
No, thank you for that, Josh. And I, looking at this slide, understanding, there's some great return to risk profile that you've done a great job of explaining that. Now, I'd be remiss if I, as a fiduciary, didn't ask you this question. But in 2008, we saw a corporate credit crisis. Can you walk us through it? And there's talks of, can another 2008 happen? Was the stimulus package going to create problems in that? Let's just say it's 2007. We're unsure of what's going to happen. What happens to a portfolio such as yours during that time? And if for whatever reason we enter a crisis period, what do you think would happen to a portfolio such as yours?
Yeah, so I can speak from experience. I think we're probably one of only a few groups that actually is still in existence, pre financial crisis. So we started the business at D.D. Shaw in 2004. We had a $2.5 billion portfolio that went through the 2008, 2009 crisis. I think fortunately, if you build and construct the portfolio the right way, which is predominantly first lien loans, lower leverage with private equity sponsors, you're able to weather it. And we saw that. And so when we did have problems, we had capital behind us to lean on in that form of a private equity firm putting in new money. I will tell you that our backgrounds are in restructuring. So we're not afraid to get our hands dirty with our businesses and work with them to turn them around. We did end up owning a couple businesses coming at us. So we ended up, having to take what I call the keys to the business. And that's something you have to be willing to do if you're in this business to achieve the right outcomes. We ended up owning a number of businesses, worked with them to achieve a turnaround. And as the economy started picking back up, we ended up selling those businesses and recouping all of our principal and sometimes a bit of a gain. And so I think it's all about portfolio construction. Even pre-COVID, we felt like the expansion from the 09 downturn had gone on quite a while. So we had intentionally positioned our most recent fund to be very defensive, less cyclical businesses, less capital intensive businesses that are harder to work with, and higher up the balance sheet, i.e. more and more first lien loans, so that we were in the driver's seat if there was that problem. It served us well during COVID, and we've seen it served us well in 08, 09. And I think, again, it's all about active management, and it's all about portfolio construction, that granularity and number of positions, the first lien loans. The floating rate is tremendous. As inflation may pick up, and maybe eventually down the road we get a rise in rates. I don't know. But I do, again, back to my slide, I think earlier, I think you got to select a manager that's got a track record that predates 08, 09. If not, everything's been roses since 09, prior to COVID, right? I think we're fortunate enough to have lived through it, to know it, and also have a track record to see how our portfolio and our underwriting has really performed.
No, and thank you for that answer, Josh. It's also why you were able to make it through the stringent Beacon Pointe due diligence process. So well done to that. Well done to you and your team. We are at about 10:35, so that's a little over the 30 minutes that we normally like to keep people on Zoom for. So I've had a few questions come in here, and Josh and Ryan, what I'm happy to do is we're going to work together to directly answer those questions offline. Again, if any more questions come in for myself with the Beacon Pointe team here, or Josh and Ryan over at Stellus, please feel free to reach out to myself at mhughes@beaconpointe.com. That's been dropped in the chat there. Ryan, Josh, thank you for your time today. Thank you for putting this together, giving us a quick run through on just the overview of private credit. Very, very, very informational. And I know that it's been very helpful to a lot of our client portfolios.
Mitch, thanks for hosting us, and appreciate everybody tuning in this morning.
Wonderful. Well,
thank you.
With that, we'll let everyone off. Thank you. Have a wonderful Tuesday, Josh and Ryan. Again, if any questions come through, you'll be the first to know.
Excellent. Thank you.